A very good afternoon to all friends. I, Sanjeev Singhal, Chairman of the Auditing and Assurance Standard Board. Welcome all of you to our third webinar for this month in the series on the auditing standards. Today's topic is auditors reporting requirements and interplay of CARO and Schedule 3 and modifications to the Central Council member from the Western region, CA Preeti Paras Savla, who is also the chairperson of the Sustainability Reporting Standard Board, and the two very esteemed speakers, CA Amit Mitra and CA Deepa Agarwal. Amit Mitra is also our special invite in the Auditing and Assurance Standard Board, and Deepa is the special invite in the Accounting Standard Board. Friends, the importance of the topic cannot be overemphasized. We all know that CARO has undergone significant changes. In all, there are 50 clauses, sub-clauses, and sub-clauses in the new CARO, and this is effective now. So the audits that you're doing for the financial year, which has commenced on or after 1st April 2021, and for which now the reporting will be done because this financial year 21-22 has ended, has to be according to the new CARO. And with the revision in the CARO, the Ministry of Corporate Affairs also revised the Schedule 3. It replicated almost all the requirements of CARO in the Schedule 3. So now the management will have to prepare the Schedule 3 according to the revised format, which is prescribed. And then the auditor is required to report on the same. The new CARO has a number of changes. For example, now there is a requirement for the auditors to report in case the, say for example, the working capital facility which has been taken by the client is in excess of 5 crore rupees, and then whether the stock and data statements submitted to the bank are in line with the books of accounts or not on a quarterly basis. There are requirements relating to the Benami property. There are requirements relating to the various ratio analysis which needs to be given. And the Institute of Chartered Accountant of India has also come out with a guidance note on the Schedule 3 in 3 parts for companies which are following accounting standards, for companies which are following Ind AS, and the NBFCs. And similarly, our guidance note on CARO is there. We have also issued an announcement relating to CARO and the interplay of the Schedule 3. And then another important topic is modifications to the auditor's report. We all know that an auditor report can be unmodified and modified. If it is modified, it could be adverse report, it could be a disclaimer of opinion, or it could be qualified report. So in what circumstances you should issue what kind of a report, that's important to know. And what should be the content of an audit report is again very important. At the Auditing and Assurance Standard Board, it's our endeavor to continuously come out with the technical material and do the technical programs. And at the same time, we are also helping our members. Now the bank audit season is on. We have constituted an online panel of experts to help our members in the bank audit related queries. This panel is operative from 1st April to 15th of April. And for the first time, and probably this is the world's biggest initiative, from 16th April, we are launching an auditor help desk for the companies as well. So there are about 14 lakh companies. So the members have any queries relating to the auditing aspects in the company audits that they are doing, we'll open our expert panel from 16th of April, and that will go on up to 30th of September. So members are encouraged to avail these facilities. And at the same time, if you want to render your services as an expert to this panel, please feel free to write to the Auditing and Assurance Standard Board. We are also working on a few very important projects like how to bridge the expectation gap. We are also coming out with a technical guide on audit trail. We are working on the auditing aspects on the Schedule 3 to the Companies Act. And there are many such projects which the Auditing and Assurance Standard Board is undertaking this year. Knowledge dissemination is a very, very important aspect of any committee of the Institute of Chartered Accountant of India. And in this endeavor, last month we have done 18 programs on the bank audits. And this month we have started this webinar series on the requirements relating to the auditing standards. We sincerely hope that members will be benefited by this initiative. We strongly encourage you to ask your questions, To the experts, please write your questions in the chat box, and depending on the availability of the time, our moderator will take up those questions with the experts. And I'm thankful to our council colleagues, CCM Priti Savlaji, who has agreed to deliver a keynote address. Preeti ji has been the chairperson of the WIRC and has very ably led WIRC, and now she's contributing extensively in the Sustainability Reporting Standard Board, and she comes with a fresh thought and with a fresh perspective. I welcome you, Preeti ji, and would request you to kindly deliver your keynote address. Thank you, and over to you, Preeti.
Thank you, Mr. Sanjeev Singhal, the Central Council member from North, for inviting me and giving me this opportunity to address the gathering. I can say that very apt topic, the season going on, and the thought which has gone behind structuring this session is wonderful. And Amit ji and Deepa ji will do the justice for the topic with the knowledge what they have. And as regards to the measures and the features, what Sanjay ji has said about auditing and assurance standard board, I think the entire year, the way in which the action plan has been planned, not only the bank audit panelists which are there for sharing their knowledge in case of the issues which the bank branch auditors are facing, but as regards to the reporting under Companies Act about the audit reports, which the panel will start, the experts panel will start from 15th April, the great initiatives which has been taken under your leadership, Sanjeevji, I really appreciate, and it will really a great worth to all the practicing chartered accountants for the company audit, because as we have seen in last year or last 2 years, various auditors have resigned as an auditor. Maybe various reasons, because a lot of frauds are happening, and we have to report a lot of things, and we are not aware about how the management is actually taking the decisions and operating the company. Further, a lot of government regulations have come in such a way, like related party transactions, the way they have structured now the strength, and the SEBI has come out with this RPT guidelines, as well as the CSR provisions and the going concern provisions which we have to report. Again, the evergreening of the loans are happening. The role of internal auditors have also been changed. So these are the things which really we have to think how and what we have to do the audits, because our roles and responsibilities have increased. And today's in economic times only, I have seen the roles and the responsibility of the statutory auditors, how they have increased along with the independent directors also. We have to think actually how the transparency, how the audit committees are actually taking the place, and what all are represented, what the roles responsibility, and how the transparent the management is, the awareness. And one more thing is about the fees. Now we have to really think the amount of fees in which we are doing the audit is really worth. So these all are the question one has to really think about it, and to do the audit, to do the justice in conducting the audit. Now we have, as Sanjay ji has said, there are 50 clauses, and I recollect that 28 new clauses, new reporting requirements, friends, than the CARO. So in earlier, 28 new, only one clause which has been deleted, and 7 continuing clauses, and 16 clauses have been modified. So now there are 50 clauses. Whether our fees will double than what we were having, one has to really think on that how much is the time invested, the team invested, the time, the energy, and what is the outcome of the audit. And if we justify that, then only we'll be able to justify the fees and justify the work what we are performing. So coming out all of things, our endeavor, and specifically the Sanjeev ji, what he is doing in AASB, the endeavor to serve the members the best so that we can come out with the best thing in the reporting, because everyone, all the stakeholders and the government and the regulating authority is watching us from all the sides. If anything goes wrong in a very simple reporting or in the companies, the first torch is on who are the auditors. So we have to be very careful in reporting and conducting the audit. So, with this, and I am sure with the sessions which are going on, and in today's session also, the knowledge what will be served will be a great value added knowledge, which will really be helpful to all the participants in performing the audit in the best way. So, with these words, I once again welcome all the participants and wish you a great learning. Thank you very much, AASB, and Sanjeevji, the chairman of AASB, for inviting me and giving me this opportunity to share my thoughts in this session. Thank you very much.
Thank you very much, Preeti. Thanks for this keynote. And we now request our speaker for the day. I think we're starting with Amit Mitra. I request Amit to kindly start your deliberation.
Thank you, Sanjeev ji. Thank you, Preeti ji, and other office bearers. Thank you for having me here, and I'm honored and privileged to share my views on the auditor's report. I'll just share my slide. Sanjeev ji, is the slide visible?
Visible, sir. Yes, sir.
Okay. So I will start. So continuing where Preeti ji left, I think the expectations of the regulators continues to change, though the standards remains there, and now we have NFRA. So the way I have structured this is that I'll briefly touch upon the regulators' expectation from the auditor's report, then coming to a little bit of literature on these standards of auditing. That also have after the basics, I will probably move to frequently asked questions from the implementation guides, wherein we will touch upon certain aspects where the practitioners are looking for answers or solutions, which could be slightly confusing. And in the end, we can have an open house. I'm happy to answer any questions that may come up. Okay, this is today's newspaper, April 13, 2022. Government is working on a plan to standardize qualification that an auditor makes in the company's accounts. This is the kind of this was never ever seen in any newspaper in India before. This is the kind of importance that is now tagged with the auditor's report. Obviously, there are reasons why we have reached here. Preeti ji touched upon a few of them. The CARO has undergone a change. The government is now set to tighten the norms for the auditors, be it the reporting or be it otherwise. So with this background, so we are in an environment where the regulators and the government is working overtime to ensure that the quality of auditors report is enhanced, and the way we prepare our opinions, be it modified or unmodified, if it is modified, it should speak the language what is expected in the standards of auditing. Next couple of slides, I have picked up certain extracts from NFRA reports of few companies wherein they have been very, very point blatantly observed certain matters flowing out of the auditor's report. And I just thought that this could be a better way, because it gives you a live example as to what is happening in today's world in terms of how the auditor's report are drawn. So I'll come to the first one. Now, the first point basically talks about companies' exposure in investment in some X Limited, which is an SPV. Now, it is noted that two of the members of the company, which is those charged with governance, explained that the SPV had sought legal opinion based on which management was confident that the underlying value was not less than the carrying value of investment. So, which means management A was confident that there was no impairment required. Now, how did this matter? How was this matter addressed by the auditors? So, auditors probably continued with the emphasis of matter paragraph, and however, the audit team actually failed to communicate and document their assessment or evaluation of the legal opinion, which was shared by those charged with governance, in terms of their evaluation or in terms of communication to those charged with governance. However, they just continued with the emphasis of matter. Now, NFRA actually concluded that this is not in line with the expectations or the expectation of the standards on auditing. The audit firm is found to have not exercised due diligence or are grossly negligent in the conduct of their professional duties and failed to obtain sufficient information which is necessary to explain an opinion or its expectations. So the moot question here is that sometimes things are there in front of us and we just tend to ignore them. Gone are the days. I think we now very, very strictly need to ensure what is there in what is the requirement of the law, what is there in the standards on auditing. Is our documentation adequate enough to ensure that it stands up in case of any regulatory check. This is the biggest example which we can see, and all this is there in public domain. You could search for NFRA reports and you will get these. Now, another situation where NFRA observed that the disclosures made by the company were not adequate, and they were disclosures pertaining to some financial instruments. The requirements are spelled out very well in Ind AS 107, and however, NFRA concluded that the audit firm had failed to ensure that the disclosures are adequate, and if the disclosures are not adequate, they were expecting that it should form part of the auditor's report. And if it is not forming part of the auditor's report, they thought that this is a suppression of fact and the audit report was non-compliant. Another situation where the parent company auditors had to comment on the subsidiary or a SPV, wherein the SPV had certain, it was a new company, and in terms of revenue, there were hardly any revenue, and it was a loss-making SPV over the years. Now, NFRA was of the view that the amount involved are material. Amounts means the investment amounts in the subsidiary company as material, and warrants the principal auditor, which is the auditor of the holding company, to perform supplemental test as per the standards on auditing 600. So generally, what the holding company auditors, again based on, let's say, oversight, would do is to pick up the balance sheet of the subsidiary companies or SPV and apply SA 600, certain paras of SA 600, and put other matter paragraph and move on. Now this, again, there are certain other paragraphs in standards on auditing wherein the principal auditor is expected to perform procedures to obtain sufficient appropriate audit evidence that the work of the other auditor, which is the auditor of the component, is adequate for the principal auditor's purpose, and there is sufficient documentation available to get comfort on. Okay, moving on. Certain other observations noted wherein the standards on auditing compliance or the accounting standard compliance was noted. Now, this matter is a matter on valuation of investment. Again, the audit firm states that the group was in the initial phase of the commencement of the project, and hence it has reported loss. And over the period, based on the projections, it will generate sufficient cash. Now, NFRA, and they had relied on the independent valuers report. NFRA verified the valuation report and um, then had commented that the audit firm should have spent some more time on validation of the assumptions for the future profits. And they believed that the audit firm failed to apply professional skepticism by ignoring the past trends of continuous losses and accepting management's false and misleading projection. Now, the moot question here is again, these things are generally made available to us that, hey, listen, here is a valuation report. And basis the valuation report, there is no impairment on the investments and there is a future projection available which has been vetted by independent valuer. One of the standards on auditing and on the accounting standards also, it is amply clear that the audit team has to ensure that the assumptions for future profits are not questionable. They are able to validate the assumptions and then they're able to positively prove that they are comfortable on the assumption before they place any reliance on. So again, then the conclusion drawn by NFRA was that the audit should have rejected the management's false projection of profit in future years without any supporting and reliable audit evidence, and instead reported this qualification in the auditor's report according to provisions of SS 705. Again, things have been in front of our eyes, and from the auditor's perspective, you can't just blindly place reliance on some other report. Due diligence activity or an audit activity has to be performed by the audit team to draw your necessary conclusions. Now, these are live examples which have been picked up from NFRA. I'm repeating. Okay, moving on. There was this question of law. Let me put it that way, wherein this SA 706, which talks about the emphasis of matter and other matter paragraph, it clearly explains that auditors shall use emphasis of matter para in the auditor's report only and only when auditor has obtained sufficient appropriate audit evidence that the matter is not materially misstated in the financial statement. So that means sufficient appropriate audit evidence has to be obtained. Now, in this case, the auditor did not obtain sufficient audit evidence and the matter was disclosed as emphasis of matter. Now, again, NFRA concluded that because the audit firm could not obtain sufficient appropriate evidence, this should have been a qualification rather than an emphasis of matter. So even if the auditors believe that they have put it in the auditor's report, but by being cozy with the clients, they are not qualifying, or they are putting it only an emphasis of matter and not qualifying, will not stand good in the eyes of NFRA. That is the point we are trying to progress. Okay, now back to some theory. In fact, I deliberately wanted to put where the regulators are, how the regulators are questioning even a single paragraph or a single sentence of what is given in the standards on auditing. And 3 standards on auditing in question are 700, 705, and 706. Please go through them thoroughly in detail to understand the nuances and ensure that the documentation is good enough for you to tomorrow support you in the court of law. So next 5-6 slides, it basically will talk of theory in terms of when do we issue an unmodified opinion or when do we issue a modified opinion. But I understand that many of you would actually want to drill down further and also sentence by sentence would want to analyze and then reach to a conclusion and understand better as to how do you distinguish between, let's say, within the modified category, whether this will be a disclaimer or an adverse opinion or a qualified opinion. Okay. A form of opinion. All of us know, and Sanjeev ji also mentioned, 2 types of audit opinions. So the auditor shall express an unmodified opinion when the auditor concludes that the financial statements are prepared in all material respects. And in all material respects is defined in the standards on auditing. Please go and have a look at that. It basically talks of compliances of all the standards on auditing, the documentation part, the reporting part, the presentation and disclosures part, and how you have gathered evidence, and then how comfortable you are on that, and whether this is in accordance with the applicable reporting framework. Now, if the auditor, based on the work done, concludes that based on the audit evidence obtained, the financial statements as a whole are not free from material misstatements, or is unable to obtain sufficient appropriate audit evidence to conclude that the financial statement as a whole are free from material misstatement, then the auditor shall modify. Obviously, vice versa, the auditor is comfortable, then you issue a clean report. However, in these two situations, the auditor shall modify the opinion in the auditor's report according to SA 705. Okay, now let's try and analyze what exactly and how do we reach to the conclusion of a modified, and within modified a disclaimer or an adverse. If sufficient appropriate audit evidence is obtained, then auditor concludes that financial statement as a whole are not free from material misstatements. Then it could be a qualified opinion, adverse, or a disclaimer of opinion. Then it depends on the auditor's judgment of whether the financial statements are materially misstated, and what is materially misstated is clearly defined, as I mentioned. And in the absence of evidence, whether financial statements may be materially misstated. So if evidence is available, then we see whether they are materially misstated. If the evidence is not available, then whether financial statement may be materially misstated, that needs to be the professional judgment, and whether the misstatement is or likely to be pervasive. So these would be the factors for us to determine whether it will be an adverse, disclaimer, or a qualified opinion. Now moving on to the right side, if you have sufficient appropriate audit evidence is not obtained, then it seems to be pretty straightforward. If the auditor is unable to conclude whether financial statement as a whole are free from material misstatement, then again, whether it is materially misstated. If it is materially misstated, then probably it could be an adverse or a disclaimer. And if it is not, it is likely to be pervasive, then we may have a situation of a disclaimer of opinion. Now, let's drill down it further and see, even between the disclaimer and adverse, how do we distinguish the two? After obtaining sufficient appropriate audit evidence, auditor concludes that whether this is an individual misstatement or it is an aggregate of misstatements, and whether they are material but not pervasive. And what is pervasive is also defined. Pervasive is primarily which will have an impact on almost entire financial statement. Now, auditor cannot obtain sufficient appropriate audit evidence. In that situation, possible effects of undetected misstatements, whether they are material but not pervasive. Now, in both these situations, you will have a qualified opinion because they are material but not pervasive. Right? So, out of the three, qualified, adverse, and disclaimer, we now understand when do we reach to the conclusion of issuing a qualified opinion. Moving on. So after obtaining sufficient appropriate audit evidence, whether this is an individual misstatement or aggregate of misstatements, then again, whether this is material and pervasive. So in the previous slide, it was material but not pervasive. In this situation, it is clearly adverse. Moving on, if auditor cannot obtain sufficient appropriate audit evidence, and the possible effects of undetected misstatements again are material and pervasive. Even after auditor has obtained the evidence, then the conclusion is he cannot form an opinion on financial statement due to potential interaction of the uncertainties and possible cumulative effects. We have a clear case of disclaimer of opinion. Now, this is a situation where the engagement has been accepted and then the management imposes a scope limitation. In this situation, what is expected to be done is that auditor will assess that this may result in a qualified opinion or a disclaimer. And auditor, the first step is that auditor will request to the management to remove any scope limitation. Obviously, if you are aware before the acceptance of audit that there will be a scope limitation, you will not accept the audit. Now, this is a situation where you have accepted the audit, and after that, management says, no, you will not be allowed to do your audit test in these three areas, which is a scope limitation. So, first step, request the management to remove the scope limitation. Now, if management does not remove it, if they remove, then the matter ends. However, if they do not remove it, then auditor will need to communicate to the audit committee or TCWG and consider alternative procedures. If he cannot obtain sufficient appropriate evidence and concludes that effects of undetected misstatement is material but not pervasive. And the second option is it is material and pervasive. So the flip side is whatever is not material in any case moves out, but whatever is material and not pervasive and material and pervasive, these are the two options which we'll be looking at. Material but not pervasive goes to qualify. Material and pervasive, we give a disclaimer. And if resignation is an option, then one could resign also. If resignation is not an option, like in case of a listed company, the window is available only to the extent of 1st of April till 14th of May, provided the financials are closed. That is one of the windows available. If the window is not available, then give a disclaimer. Okay. Now again, moving to some literature, some examples, to practical examples to make you understand as to when would you actually disclaim and when would you actually use an adverse opinion. In case of disclaimer, management do not allow access to the financial statements, including communication with component auditor in respect of a component representing 90% of the group assets. So you are the auditor of the holding company and management is not allowing you access to your subsidiary or any other component which is material, significantly material. In that case, it is a clear case of disclaimer of opinion. You will still not be able to use SA 600 here. Now, adverse opinion. What could be an example, good example of an adverse opinion? The entity's financial arrangement has expired and management is unable to conclude on the renegotiations or obtain replacement financing. This situation indicates that a material uncertainty exists that may cast a significant doubt on the company's ability to continue as a going concern. Now, this fact is not adequately disclosed in the financial statements. In this case, it is tantamount to a disconnect between the auditor and the auditee. And this is again all pervasive because we're talking of something related to a going concern. This is a fit case of adverse opinion. Okay, so as I mentioned, the idea here is to explain the text, A, through what are the expectation of the regulators, and B, we have touched upon some literature. Now, the third part is basically certain FAQs which have been picked up from the implementation guide on the reporting standards. Okay, so generally people have a confusion where it is generally asked whether SA 700 is applicable to audits for which SA 800 or SA 805 applies. So I am assuming that all of you or most of you would be aware of what SA 800 or SA 805 means. So SA 800, for the benefit of everyone, SA 800 and SA 805 are special purpose audit report on special purpose financial statement. 805 is primarily issuing opinion on single financial line item. So in this situation, the applicability is yes. The answer is yes. In both the situations, SA 800 and SA 805, the requirements of SA 700 will be applicable while you're forming an opinion or forming and reporting an opinion. So it should be considered. Okay. In fact, this slide should have been before the previous slide. However, again, this table is picked up from SA 705, and it is a very beautiful table. Basically, summarizes everything what we have already studied. So I will just repeat. So where financial statements are materially misstated, right? Where financial statements are materially misstated, but they are not pervasive. They are material, which means you will certainly qualify, but they are not pervasive. So which means it is just a qualification. Now, a second situation where it is pervasive also. It is material, which means that you would need a modification, and it is pervasive also. In that situation, you would give an adverse opinion. Now, in a different second situation where the auditors have shown their inability to obtain sufficient appropriate audit evidence. Again, material but not pervasive, you will issue a qualified opinion, and material and pervasive, you will issue a disclaimer of opinion. I think this table clearly spells out the requirement of the law in terms of when do you use an adverse or when do you use a disclaimer. Okay, moving back to the FAQs. When should an auditor refuse to give a clean, which is unmodified opinion? Okay, now again, someone would say if you do not find anything in simple layman terms, you give a clean or an unmodified opinion. Now we have seen NFRA cases. We have seen where the documentation was short. The regulators have questioned the clean opinion. So, technically speaking, there can be two situations. When the auditor has obtained sufficient appropriate audit evidence and when the auditor is unable to obtain sufficient appropriate audit evidence. And when we say the auditor has obtained sufficient appropriate audit evidence, it needs to be documented in the audit files is what the requirement of the law is. If it is not documented, then you automatically falls into category B, even if you have done the work. So now in the first situation, he cannot give an unmodified opinion if he reaches to the conclusion that the financial statements taken as a whole are not free from material misstatements. In the second situation, due to non-availability of sufficient appropriate audit evidence, he does not have the ability to reach to a definitive conclusion that a financial statement taken as a whole are free from material misstatements. So in both the above situation, the auditor is expected to modify the opinion as per SA 705. And when the reporting under a fair presentation framework, if the auditor concludes that the fair presentation is not achieved, then he should discuss this again with the management to resolve this issue. And based on the outcome, it needs to be decided whether a modification should be given. If modification should be given, whether will it be all pervasive. Like a going concern. Going concern is a fit case. It is all pervasive. Where the entity does not have any material uncertainty, again, going concern matter. In this situation, where an entity does not have any material uncertainty, which means the company is profitable, the projections are good, or even if the company is not profitable, there is sufficient cash available and the projections are good. And now, in this situation, uh, let's look at the question. Where an entity does not have any material uncertainty regarding the entity's ability to continue as a going concern, generally 12 months, should the auditor's responsibility paragraph continue to include the disclosure as required by SS 700? Again, the answer is yes, because this has nothing to do with how you would put a SA 570 paragraph, which is an emphasis of kind of an emphasis of matter paragraph. Again, I'll just read the text also. So, regarding an entity's ability to continue as a going concern, the auditor's responsibility paragraph regarding going concern would need to be included. So, that paragraph basically talks about the auditor's responsibility, and it does not have anything to do with how the company is performing in terms of the going concern and whether there is any reporting requirement to be done on. This is because auditor's responsibility paragraph provides a summary of responsibility, including going concern assessment. So please do not, and this is a very common question. So please do not confuse that if going concern is okay, should we remove? You cannot remove from the auditor's responsibility paragraph. Okay. Now, where management imposes a scope limitation, I have covered this as part of the flow chart. I will move on to the next slide. Okay, where the impact of the misstatement is pervasive. Okay, now we know that if the impact is pervasive, then we have two situations where it pertains to an amount in the financial statement and it is not confined to a specific component, account, balance, or an item of the financial statement. Then it represents or could represent a substantial portion of the financial statement. That would be termed as pervasive. So I'll repeat again. What could be termed as pervasive, where it pertains to an amount or a combination of amounts in the financial statements, and it is not confined to a specific component only, and account or items of the financial statements. So it should not be confined to a specific component only. If it is so confined, it represents or could represent a substantial portion of the financial statement. So it should not be confined to specific components, accounts, or items. If it is confined, then that line item has to be really, really significant. And what is significant is generally is a substantial portion, generally a high percentage, more than 50%, the high percentage of the financial statement. Substantial in other places is defined as 20% also. So even a 20% substantial portion in the financial statement could be considered as this. But what is substantial generally not defined. Generally for audit qualification, audit whether this is all pervasive, benchmark generally taken is anything more than 40%. Again, I'm saying substantial portion is not defined. Substantial interest is defined, which talks about more than 20%. And B is where it pertains to disclosures, and such disclosures or matters therein could be fundamental for the user's understanding of the financial statement. So like a going concern. The disclosure is not there, then it is pervasive. Okay, so we have two examples here. The first one is where an auditor detects a bias in the valuation of estimates on the asset side. Estimates could be increase in the useful life of fixed assets, or impairment testing in the investments, or other than temporary investments. or doubtful receivables and not adequately providing in the inventory obsolescence. So the whole combination of fixed assets are being covered here. So all of this, a combination is building up to an overstatement of earning, the aggregate effect of which could be material to the financial statement. Now this is pervasive. This is an excellent example of what is pervasive. Another example, the entity is unable to resolve to the satisfaction of auditors that a going concern issue in relation to one of the subsidiaries which needs to be disclosed, but it was not disclosed. Combination of unmodified opinion and adverse. This is fairly simple. If you have already, the question is, if you have decided to give an adverse opinion or a disclaimer of opinion, is it still possible for the auditor to give a clean opinion on few account balance where he's been able to get comfort upon? The answer is a clear no. Once you have decided to give a disclaimer or an adverse opinion, and that is all pervasive, that you cannot have two different opinions within one opinion, and adverse or disclaimer opinion will overrule the clean opinion. However, in SA 805 situation, which we talked about earlier, if you're opining on a single element or a single component, then, and if you've got comfort on them, then the situation can be different and you could do that. Impact of modified report on internal financial control. Okay. So you have issued a modified report. Would that mean that it will also have an impact on the IFC reporting? The answer is yes. It should have an impact where the auditor's report is modified, qualified, or otherwise. When we say should, it means 99.9%, unless and until, I can't think of a situation, but unless and until there is a situation which could be argued, but 99.9%, the IFC will also have an impact. So what is the situation vice versa? Which is on the next slide. Yeah. If the IFC is modified, then will it have an impact on the main auditor's report? This is not necessary. This is not necessary. A modified report on the IFC does not necessarily imply that the audit report on financial statements should be modified. Now, in an audit of financial statements, and the reason for that is that the assurance obtained by the auditor is through both testing of internal controls and performance of substantive procedure, which is the test of details in a normal parlance. Therefore, if the auditor is of the opinion that the results of substantive procedures performed are sufficient, appropriate, then probably, and all the risks are covered, then probably you may have a situation where you do not modify the main report and your IFC report continues to be modified. Okay. Consolidation is again one very tricky question. It is extremely common now after the consolidation coming in. Now the question here is that whether the principal auditor has to mandatorily reproduce all the observations of the component auditors and ensure the same is in compliance with the requirements of SA 705. Again, the answer here is that if the principal auditor will have to analyze and see that whether the modification is significant and it will have an impact on the consolidated financial statements on which principal auditor is appointing, then yes. However, if it is insignificant, if it is not material, and it does not have any material bearing on the on the consolidated financial statements, then it is not required. So once the parent auditor concludes to include the qualification, which is the principal auditor thinks that this is significant and the modification is of such nature that it needs to be covered in the consolidated financial statements. In that situation, one would need to comply with the requirements of SS 705. Okay, now moving on to the emphasis of matter and other matters in the auditor's report. Now, again, there are certain tables that I have for more clarity as to what exactly is the difference between an emphasis of matter and other matter. When do you use an emphasis of matter and when do you use other matter? However, it is important for an auditor to consider it necessary to draw users' attention, where the auditor considers it necessary to draw users' attention to a matter or matters presented or disclosed in the financial statement. So, which necessarily means, now in that situation, you would actually use an emphasis of matter. So, which means the matter should already be either presented or disclosed in the financial statement. Disclosed will be in the form of a note in the notes to accounts. If that is the situation, then generally you would use an emphasis of matter. Now, moving on to B, when the auditor considers it necessary to draw users' attention to any matter or matters other than those presented or disclosed in the financial statement, but which are relevant for the user's understanding of the audit or auditor's responsibility. So here the word used is relevant for the user's understanding. And in paragraph A, it was written that which are fundamental for the user's understanding. So the broad guidelines is where the matters are presented or disclosed in the financial statements, and it is fundamental for the user's understanding. We use an emphasis of matter, but where the matters are not disclosed in the financial statement as a notes to accounts, but are relevant for the user's understanding of the report, then we use a other matter paragraph. Okay, and again, very widely noted point that many auditors actually use emphasis of matter paragraph to put a qualification. Now, this is a clear non-compliance of both the standards 705 and 706 and then 700. If you need a emphasis of matter, and we will come to situation when do you actually use an emphasis of matter. The broad conditions we have discussed above, which is fundamental to the user's understanding and disclosure. Some disclosure has to be there in the financial statements. So do not use emphasis of matter paragraph where you are required to either give a qualification or you are either required to give an adverse or any other opinion. Examples of emphasis of matter, impact of COVID-19. For this, you could use an emphasis of matter. Then, if there is a pending litigation and then the auditor has relied on an eminent lawyer, any major subsequent event like a fire or effects of the fire, scheme of merger or demerger. So all these could be examples where you would use an emphasis of matter. And in all these cases, in the back of the mind, you may have already thought that there will be a detailed disclosures available in the notes to accounts. Now, what could be examples of other matter paragraphs? So let's say where the comparatives are not audited. It may not have because it is pertaining to audit, it will surely not have any paragraph in the notes to accounts. Or where financials were audited by another auditor in the previous year, or physical verification of inventory was not performed due to COVID-19 and evidence obtained through alternate audit procedures. Because again, this is pertaining only to the auditors. It has nothing to do with the disclosures in the notes to account. Or other matter paragraph in the auditor's report of the consolidated financial statements on component audit done by another auditor. So where the parent auditor is different from the subsidiary auditor, the parent auditor generally would have a SS 600 paragraph as other matter that this auditor has not performed the audit of the components. So in all these situations, you would now be able to visualize as to when would you actually use other matter paragraph. Consolidated audit report and other matter paragraph. Again, slightly touched in previous slides, where the audit is performed by another auditor. As per SS 600, you will give another matter paragraph, or the other matter on the component being a foreign entity whose financial information prepared as per GAAP accepted in the local jurisdiction, and the conversion were only audited, which means the main audit was done by an international auditor as per their local jurisdiction, and the parent auditor has done the conversion adjustment. Or another example could be where uh, qualifications of EOM in the standalone report of the component, which is a subsidiary, are taken care in the console report, considering materiality and relevance at the group level. Okay, I will straight away come to the examples in the interest of time. And these bullet points are again cut, copy, paste from the standard SS 706, which means the intention of the law is to, and this is more or less an exhaustive list. I will not call this as an exhaustive list, but the color needs to be taken from these 6-7 points. I will just read out very quickly. Where there is an uncertainty relating to future outcome of an exceptional litigation, in that situation, you would give an emphasis on matter. And the subsequent event, we saw an example. Subsequent event where a fire took place, major fire took place, that subsequent event will form part of emphasis on matter. Then early application of a new accounting standard that has a material effect on the financial statement. A major catastrophe which COVID-19 generally gets covered here. Unconventional interpretation of an accounting standard, and that an entity have taken, even though auditors are fully in agreement with that. So situations like this generally would get covered under the emphasis of matter paragraph. Okay, now what happens in a situation where auditor disagrees with or is uncomfortable about the recognition, measurement, and disclosure or presentation of a transaction, or even reflected in the financial statement? For this, do you think an emphasis of matter paragraph can be given? Obviously, the answer is a big no. If there is a disagreement, then it is not an emphasis of matter. Emphasis of matters are only given in situations where the matters are appropriately presented and the auditor is deemed to be in agreement, which means auditor is in agreement with those situations. In this situation, it could be modification of opinion, and depending on the pervasiveness, one would need to judge whether it is a qualification, adverse, or a disclaimer. Okay, this we have covered. Now, the other matter paragraph, what does it not include? So we initially in our slides we have seen what it includes. What does it not include? So any matter that is required to be presented or disclosed in the financial statements. So wherever a matter needs a disclosure, that means it is straight away out of the other matter ambit. If it would be covered, it would be covered in the emphasis of matter. Another situation could be where the information that auditor is prohibited from providing by law or any regulation or any other standards. In that situation, the other matter paragraph is not required. Or where the information that is required to be provided by the management. This is because auditors should keep away from trespassing into management territory. So where the management was required to provide certain information, however, if that was not provided, it generally would tend to, if it is material, it generally would tend to be a qualification and not another matter paragraph. This other matter paragraph cannot be used for such information. Okay, just a brief synopsis. This is emphasis of matter where matters are presented and disclosed in the financial statements, and other matter where matters not presented or disclosed in the financial statements. again fundamental to the user's understanding, and which is in other matter it is relevant for the user's understanding. Understanding generally emphasis of matter is understanding of the financial statements. Another matter could be understanding of the auditor's report and auditor's responsibility. So happy to have questions.
Open floor. Thank you so much, sir, for the wonderful deliberation. We are having with us our Honorable Vice Chairman, WSDCA Vishal Doshi ji. So may I request our Honorable Vice Chairman, sir, to please start the further proceedings of the VCM, sir. Over to Vishal.
Thank you, Anil ji. Very good afternoon, friends. Thank you, Amit ji, for an excellent presentation on the topic of modifications in the auditor's report. So there are a couple of questions. With your permission, if I can ask them.
Yes, sir. Yes, sir.
Why is CARO not made mandatory for bank and insurance company? Any specific reason for its exclusion?
So I will park this for Deepa. Deepa would be taking the CARO. So
sure. Okay. The next question I think we can answer collectively. What is the minimum fees chargeable for private limited company for statutory audit appointment? I think the ICA has already come out with the recommended scale of fees. And I feel that you don't need a mandatory. If members of their own voluntarily also follow the recommended scale of fees, I think so that itself would be a blessing for all of us. Yeah, Amit ji, your call.
No, I completely agree with you, and this is very, very subjective. Only thing is that, and as Preeti ji also mentioned, that it is not time that we have to have a relook at our fees and ensure that we get good recoveries. And the reason why I say that is that the attest function is now taken very, very seriously with the regulators. So it is good to attach a price tag to this.
Yeah, I completely agree that it is we ourselves who would be responsible for benchmarking ourselves. This is all I can say. So I would request members that the ICI has announced the minimum recommended scale of fees. It is recommendatory, but even if members mandate it upon themselves individually that this is the bare minimum that I am going to charge, I think so that would uplift the whole profession. So the next question is that cash flow statement is not prepared by the company on the pretext that it is not applicable. How to report it?
So cash flow in most of the situation, it is now part of the definition of financial statements. I would be surprised. It could be a very, very, very small company where probably cash flow is no more applicable. Otherwise, it is applicable. If they are not preparing it, then it has to form part of the auditor's report. It is a non-compliance of Schedule 3. It needs to be qualified.
Right. True. I agree. So whether a disclaimer report can carry any UM, and also about audit under situation of missing documents due to fire, etc. What could be the possible course of action for the auditors?
Yeah, so I had covered in one of the slides. So if the report, auditor's report contains a disclaimer, then disclaimer is all pervasive. You won't have an emphasis on matter paragraph. What was the other question? The other question was on, I think,
missing documents due to fire, etc. What would be the course of action for the auditors?
Yeah, so I think it's a clear case of scope limitation. If the auditor is not able to get evidence, then that auditor tomorrow would not be able to document or protect himself in front of the regulators. Auditor has no option but to qualify or disclaim. It's a clear case of scope limitation.
Correct. Agreed. So in case of related party transactions, whether the balance confirmation received from related parties, can we accept that as part of the audit procedures and documentation?
So surely this is an accepted procedure. There could be many other procedures also. So one of the procedures is this, which is accepted. Surely yes. But it has to be independent. I mean, it can't be flowing from the company.
Correct. So the last question, in statutory audit of life insurance companies, the actuarial reserves form the material liabilities and the same is exempted by ICI from an audit. How the statutory auditors are forming opinion when a material portion of the liability is relied upon the certificate from actuaries.
Yeah, so I would want to park this. I'm not doing insurance companies, but I will be able to check back from our financial services team and respond to this.
Correct. So if I also can contribute a little bit to it, that even in case of a normal financial statements, though not a significant portion, but we do accept actuarial liabilities with respect to the employee benefits and all. So they may not be a significant portion, but yes, whereas auditors, I believe that we are not competent enough to I would say put a number against a particular reserve. We have to rely on the other experts, and we have the standards on audit where we are permitted to rely on the other experts, either by the company or appointed by the auditors, and we can have the related documentation. So maybe Amit ji or Deepa ji, if you want to add to that response.
Yeah. Thank you, sir. Am I audible? Yeah, I just want to add that, as you rightly said, that there are auditing standard wherein you can use the work of the management expert as well as the auditor's expert, but ultimately the responsibility remains with the auditor. So we use them as an audit evidence because, as you rightly said, we have the expertise to make such valuations, and therefore, even if we go to the accounting standard, if we mention, refer to AS 15 for that matter, that talks about use of an actuarial. So therefore, the standards recognize that the use of actuarial has to be there. But yes, as you rightly mentioned, that we have to have sufficient documentation in the file because we are not going to refer to the work when we are forming an audit opinion. So we are not going to refer to the expert in the audit opinion. I just want to highlight that.
Right. Thank you for that response, Deepa ji. Thank you, Amit ji, for a really detailed session on the modifications in audit report. And I believe that after your session, members would be, I would say, emboldened to at least mention things in the emphasis of matter or the qualification as and when it is required based on our standards. And friends, I would just like to add something over here, what Amit ji has covered in the last 1 hour. I'll just sum it up that as auditors, it is our responsibility to give an opinion on the audit report, and it cannot be management's opinion, it has to be auditor's opinion. And with that, once again, I would request you all to please ensure to take care that we sign off our opinion in the audit report in the right perspective as the stakeholders expect us to do. Thank you, Amit ji, for an excellent.
Thank you, sir.
Once again. Friends, we move on. We have the next speaker, CA Deepa Agarwal, and she is going to take us on the auditing reporting requirements under CARO and Schedule 3. Thank you, Deepa ji, for your time, and over to you.
Thank you. Thank you so much, sir. And thank you for inviting me and yet giving me again this opportunity. With this, without taking much of the time, I'll quickly share my screen with all of you. Yeah. So is the screen visible?
Yes, sir.
Okay. So while the time given to me, I understand that we have less than an hour. But yeah, I'll try to cover the key requirements here. And the topic why I selected is and why I even suggested that probably it will be a good topic is the new auditors reporting requirement as we move towards March 2022 audits and the interplay of CARO 20 and Schedule 3. So as Sanjeev ji mentioned and Preeti ji and Vishal ji mentioned that, as auditors, we have a very important role to play and it's an onerous responsibility. And with the given set of changes which are happening and which have already happened and which are applicable for March 22 audits, it becomes very important for us as an auditor to understand how our responsibilities are changing, what additional efforts are required, what additional documentations are required to be maintained. So, so if I just talk about the slide which I've put together, is to just to give you an overall perspective. When I talk about, when I say I means an auditor, when we talk about as practitioners, as chartered accountant, as auditor, talking about how our responsibility has changed and evolved over a number of years. So if I start with the main audit report, so we have a SA 700 which have been very well and covered in a very comprehensive manner by Amit. So Amit mentioned about 700 use of other matter, emphasis of matter paragraph, and your qualified opinion. So we have those standards which were revised 2 years back, and those standards were revised in line with ISA 700, wherein you start with the opinion paragraph and you had a very detailed auditor's responsibility paragraph, and key audit matter was also made mandatory for the listed companies. And then we move to the other section, which is in other legal and regulatory matters, such as books of account, adverse effect on the functioning of the company. And then if I talk about amendment within this section, there is no change in the main audit report when we talk about SA 700, the true and fair view of the financial statements. But when I move to the report on legal and regulatory requirements, it is very important to note that they have significantly amended these requirements for the auditors. So we will cover in this session the new requirement on the funding transaction, which is your Rule 11E and F, which have been introduced by the MCA and which are applicable for March 22 to all the companies. Please note the word these are applicable to all the companies. No exemption to any of the companies here. So companies are companies governed by the Companies Act 2013. And then you have a separate assertion on compliance with dividend norms. Audit trail, we will not cover in detail because this has been deferred again, and they have currently only deferred it. The MCA has made an amendment for the amending it to the company's accounts rule. So if you will go to the MCA site, you will see there is a notification which talks about amending the company's accounts rules. And now for the companies, it's applicable from 1st April 23. However, the audit trail rules are yet to be amended. So, but I presume that both will be in sync because auditor cannot report without the management having the responsibility to maintain an audit trail. So if I talk about the legal and regulatory requirement, you have in total around 17. But if you exclude this audit trail for the current year, you will have 16 reporting requirements for the legal and regulatory requirements. And if I talk about IFC, internal financial control, there is no change. The ICA guidance continues to remain intact on the guidance note or ICFR, which we should refer for March 22 audits. And then you have CARO. I think everyone mentioned that we have now 50 clauses and sub-clauses put together. So significant changes have been made to Schedule 3 to align with CARO 2020. And around about 10 specific disclosures have been added in Schedule 3, which you will see that have been added just to align with CARO 2020. And there is a guidance note on CARO 2020, which provides detailed guidance on the various reporting requirements. Now, with this, I'll move to the first. I'll cover the legal and regulatory requirements section, which I mentioned in the first slide, that these are around 16 requirements on which the auditor has to report in addition to your CARO report. So if you remember, there's a section on 143.3, which talks about that we have to report whether we have obtained all the information and explanation which are necessary for the audit, proper books of account have been kept, observation comments of the auditor which have an adverse effect on the functioning of the company. While these are all the containing matters A to J, but if you go to this K, Rule 11, other matters to be included in the auditor's report, the additions are D and E. So they've added that the auditor has to report on the transaction to benefit the ultimate beneficiary. We will cover in the next slide what are the detailed reporting requirements. But yeah, there's a specific requirement now wherein the auditor will have to report in the auditor about such funding transactions. And yes, the Schedule 3 also has a corresponding disclosure to be given by the companies in the financial statements. And then you have a specific reporting requirement on dividend norms and then audit trail. The accounting rules have already deferred. So probably this will not be required for your year ending, so since these are deferred, so probably this will not be applicable in the current year. Now, covering the first amendment in the accounts rules, the auditors rules, which happen, and the requirement is to report in the report on other legal and regulatory requirements. So here, the reporting requirement, if you see, it's quite onerous. So I'm sure many of you would have already read and started applying when you're preparing for March 2022 audits. And ICA is also in the preparation of the detailed guide for the members, so that they can actually apply in practical to deal with such situations. So if you look for the reporting requirement, it talks about whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes to account. So if I just break this sentence into three: one, the auditor has to obtain a management representation. Second, the management has to make a representation basis the information and the fact that there is a disclosure in the notes to account. So which means the management has to make a disclosure in the financial statements and make a representation to the auditor that they have given the complete disclosures in the financial statements. Now, what is the representation? Representation is in two parts. One, the advancing or the granting of the loans. So the company has not given or advanced any funds. And if you read the term, the advance loan or investment is very wider. It could be your borrowings, share premium, any source or any kind of fund by the company to any other person, including foreign entities, with understanding, whether recorded in writing or otherwise, that the intermediary shall, whether directly or indirectly, lend or invest in other person or entities identified in any manner to provide any guarantee, security, or the like on behalf of the ultimate beneficiaries. Now, let's try and understand the intent of the amendment before before we get into the wordings. So this is just to make sure that the issue under consideration was the camouflage transactions, or the to identify the masked entities or who are the ultimate beneficiaries. So by camouflage investment, we mean those transactions which are undertaken by a company for some identified beneficiary, the hidden beneficiary. However, the transaction does not take place between the company and the ultimate beneficiary directly, but is routed through a inclusion of an intermediary entity, and which is an intermediary entity acting on instructions of the company for channelizing the funds to any other entity identified by the company. Therefore, the requirement was introduced by the MCA to make such disclosure to identify such ultimate beneficiary. And if you look at the second, the subclause, it talks about if the company is a recipient. So which means the company has received the funds, and the company has received the funds to ultimately pass it on to any other entity. So if you read, it says no fund have been received by the company from any person, including foreign entities. It is very important to note the term here. It also covers foreign entities, with the understanding whether recorded in writing or otherwise. Now, these terms are also again very important, that the understanding can be oral based on agreement, can be so again it's very difficult for the auditor to make such to audit such oral understanding and to find the evidence. And therefore, the practical challenges come that it's not just the limited to the writing. The agreement, it could be even based on oral understanding. And if the company has received such fund to lend or to invest on behalf of the funding party, or provide any guarantee or security on behalf of the ultimate beneficiary. So which means the company may have received the funds, and which will be ultimately either invested into an ultimate beneficiary, or will be given in the form of guarantee or security. And the auditor will have to perform the procedures in addition to the management representation. So one should be very clear that it's not purely based on management representation. You will also have to perform detailed audit procedure, maintain documentation in your file before you actually report that nothing has come to your notice that caused you to believe that the representation under 1 or 2 contains any material misstatement. So this is something very important, and there is a disclosure requirement in Schedule 3 under additional regulatory information and utilization of borrowed fund and share premium, which the company has to give in the financial statements. The other And I'll cover the implementation issues also in the next slide. The other reporting requirement is on the dividend declaration. So one can argue that as part of SA 250 or compliance with laws and regulation, the auditor is required to check whether the dividend declared or paid by the company is in accordance with Section 123 of the Companies Act. However, it is important to note now the auditor has to make an explicit assertion in the auditor's report talking about whether the company has declared or paid. So which means the company would have declared the dividend. It could be a non-adjusting event requiring disclosure in accordance with AS4 or in AS10. Still, the company will have to, the auditor will have to check whether the dividend declared is in accordance with the requirement of Companies Act or paid. So, for example, there's a requirement in Companies Act that the dividend has to be, when paid, paid means it has to be transferred first to the separate bank account within 5 days of declaration of the dividend, and thereafter it has to be paid to the ultimate shareholders. So, which means the auditor will have to perform all the work steps. The auditor will have to maintain sufficient working papers in the file before making this explicit assertion. And compliance with the Companies Act as well as the underlying dividend rules. As I mentioned, ICAI is in the process of developing guidance, and I'm sure that once the guidance will be released, it will be useful for the number of practitioners. This is on the audit trail. So again, I'll not spend much time here because these have been deferred for a year. So, so the requirement is to, the auditor has to report whether the company which is using an accounting software for maintaining its books of account has a feature of recording audit trail. And the auditor will have to report whether the same has been operated throughout the year for all transactions recorded in the software. And the auditor also has to report that the audit trail feature has not been tampered with, and the audit trail has been preserved by the company as per statutory requirements for record retention, which is actually a period of 8 years. If you go and see Section 128, it talks about that these statutory records have to be maintained for a period of 8 years. Now, I'll just talk about some, some of the implementation issues of the new auditor reporting requirement. So, date of applicability, as you have seen in Rule 11E and F, which is your funding and dividend. These are applicable for financial year beginning on or after April 2021. The reason why I'm highlighting this because if you're auditing a calendar year company, it is very important to note that it is applicable for financial year beginning on or after April 1, 2021, which means if a company is following a January to December calendar year end, it will be applicable for the year commencing 1st January 2022. It will not be applicable for the financial statements which are being signed, closed for December 2021. The other important point which you need to keep in mind that while I'm going to talk about Schedule 3 interplay with CARO, all the corresponding disclosures have to be given by the company when they are disclosing under Schedule 3, which means as an auditor, you will also have to perform procedure on the corresponding figures. Because there is no exemption in Schedule 3. So if I give you an example of the aging analysis or the CWIP disclosures or the struck of companies analysis, the companies will have to give the corresponding disclosure for the comparative number also. So in this case, we will have 21-22 as your current year and 2021 for your comparatives. So auditor will have to evaluate whether the company has given sufficient disclosures. If there is the disclosures are not given, then again, the auditor will have to evaluate the implications on the auditor's report. Another issue which comes is what type of funding transactions are covered. So all types of transactions are covered. So if you see that it covers a wider range of funding transactions which are given for passing on to the ultimate beneficiary. And also one important point to note, Schedule 3 has an additional disclosure requirement which the company has to give. So the company will also have to make an assertion in the financial statement that whatever transaction they are doing with ultimate beneficiary, they are in compliance with the provision of the FEMA and the Companies Act, and the transaction are not violative of the Prevention of Money Laundering Act. So when the companies are making this assertion for these funding transaction, the auditor will have to will also have to assess and will have to see whether the company has made such a declaration. Also, as I mentioned, that the funding transaction, again, it could be through your contractual agreement. So which means, for example, company A has given fund to company B for passing on to company C. Now that could be in writing, demonstrated through a contractual agreement, or it could be even through a verbal understanding, which means there are no instructions in writing, but ultimately the funds have been given for passing it on to the ultimate beneficiary. So again, it is a significant level of judgment involved in this arrangement. I'm just skipping the example in the interest of time, but on the audit procedures. So again, these are some illustrative audit procedures, but you will have to, when you are doing a funding transactions audit, so you will have to look at the internal controls. You will have to see the evaluation of the relationship with the funding entity. You will have to obtain the list of loans given investment made during the year, including transaction which have been acquired of during the year. So which means even if the amount has been repaid by the end of the year, such transaction will also need to be evaluated. Another question, which comes very often is that on the definition side. So, for example, if you talk about CARO 2020, at times how do we deal with a mezzanine loan, which actually is a loan, but it could be classified as equity or a compound instrument under India's framework. The guidance note on CARO 2020 clarifies that we will have to see the definition when we apply CARO as well as the Companies Act requirement from a legal perspective. So here you will have to go by the legal definition when we are looking at loans and guarantee, and not by the India's definition. This is on the dividend. As I mentioned, that now the auditor will have to make a positive affirmation that the company has declared the dividend, and which is in accordance with Section 123. So it is important to note that dividend includes interim dividend, and accordingly reporting obligation covers interim dividend. Some important points for consideration is that you have to see the dividend rules as well. Dividend rules prescribe certain restrictions in the amount of dividend. If the company has incurred loss and the company proposes to declare dividend out of free reserves, make sure that the company is in compliance with transfer of profit to reserve rules. Also, there is a secretarial standard on dividend and the guidance note on dividend issued by CSI, which you can refer when you actually see the application of the rules. Audit trail, as I said, I'll skip for the time being. And so on the applicability, the new reporting requirements are applicable to all the companies, including Section 8 companies, foreign companies, for example, liaison office, branch office. In this, you can even refer to the Rule 5 sub 2 of registration of foreign companies rule, which talks about that the provision of Chapter 10 are applicable to the foreign company as well. The reporting requirements are applicable to your standalone as well as CFS auditors reporting requirement. Consolidated financial statement may include some group entity which are either not companies under the 2013 Act or are incorporated outside India. So unless and until such companies are foreign companies, which are within the purview of Companies Act, it will not be applicable. So when I'm the parent auditor or I'm the auditor of the holding company, I'll only report on these requirements to the companies. I'll seek information from the component auditors as required by SS 600 for the component which are companies registered under Companies Act. Another very important point is to note that we will have to report even if there is no transaction. So, for example, I mentioned about the transaction given for the ultimate beneficiary. Now, there could be a situation where there is no such transaction. So then in that case, also the auditor will have to make a assertion that as disclosed by the management in the notes to the financial statement, there is no such transaction and the auditor will have to report accordingly. Also, if the company has not declared or paid dividend during the year, the company will have to make a assertion accordingly in the auditor's report. So the principle is the auditor will need to provide comments even if no exception was noted. Now, with this, I'll move to CARO 2020, and I'll start with the question which was left that why CARO 2020 is not made applicable to the banking company and to the insurance company. So, so if I just give you a broad perspective on CARO 2020, so one, it was never applicable. So if you go to CARO 2015, if you refer to CARO 2016, it is not applicable to a banking company or to insurance company. The reason being these are governed by Special X. So if you look at the banking company, you will have to see the circulars issued by RBI, the many of the regulation issued for the banking companies, and so is for the insurance company. So this is how I understand probably, but yes, probably the regulators will have a better understanding for giving that exemption. But if you go to the original CARO as well, the exemptions were always there, and there is no change in the applicability criteria in CARO 2020. And as you know, mentioned by Sanjeev ji in the beginning, that these are 50 clauses. So definitely, the reporting requirements are more than double. So earlier we used to report on 21 clauses and sub clauses put together, and now we are going to talk about 50 clauses. So if I start with the applicability, so there is no change. It is applicable to every company, including foreign company, except banking company, insurance company, Section 8 companies, 1% company, small company, and private company within the threshold. So you have some exemption in the private companies. Not all private companies are covered. And order not applicable to investment trust and real estate investment trust governed by SEBI Infrastructure Investment Trust Regulation. And if you look at the breakup of the clauses, so there is only one requirement which has been deleted, which is on the managerial remuneration. And the reason why it has been deleted is because it was a duplication. You already have a requirement to report on the managerial remuneration in the section on report on other legal and regulatory requirements. So since there was a duplication, they removed it from here, but retained it in the main auditor's report. So effectively, there is no deletion. But yes, we will have to report on 50 clauses and sub-clauses put together. Now, first, I'll just take you through the announcement which was released by the AASB and also mentioned in the beginning. So ICA issued an announcement on guidance note on companies auditors report 2020. In nutshell, if I just explain, the guidance note was issued at the time when Schedule 3 was not amended. So which means the CARO 2020, the auditor's responsibility was issued by MCA earlier, and the ICA issued a guidance note as well, because CARO was deferred twice. So initially, the expectation was the auditor to report on the number of clauses and sub-clauses as you have seen in CARO. However, based on management has done various representation, the industry representation, the regulators representation, the CA fraternity representation, finally, CARO was deferred and MCA issued a revised Schedule 3 on 24th March 2021. So if you see now, CARO has multiple disclosures. CARO has multiple reporting requirements, and out of which around 10 have been built into Schedule 3. So therefore, the ICA guidance, what AASB has issued a guidance, it talks about that while the guidance note is under revision, which will take, which has a process as per the ICA framework, the members are required to read CARO 2020 in conjunction with the corresponding amendments made in Schedule 3 to the Companies Act 2013 for presentation and disclosure requirement stated therein, and perform the audit procedures accordingly. So what does it mean? It means that when you are reporting in CARO 2020, you please take cognizance of the Schedule 3 disclosure and presentation requirement. And accordingly, you perform your procedures and maintain your working paper files. So if I move to the next slide, now this is just a table and it's just built up from the IC announcement. So on the left-hand side, you will see the reporting requirements under CARO 2020. On the right-hand side, you will see the disclosure requirement under Schedule 3. So the first one is on the title deed. So this is not a new reporting requirement in CARO. Yes, they have made some few edits in this clause in CARO 2020 as compared to CARO 2016. However, there is no significant change, but now they have added a disclosure in Schedule 3. Similarly, for the PPE, they have a corresponding disclosure requirement in Schedule 3, whether the revaluation is based on the valuation by register valuer, and the disclosure of the revaluation has to be made if changes 10% or more in the aggregate of net carrying value of each class of PPE and intangible assets. Then you have the Benami transactions, that whether there are any proceedings initiated pending against a company for holding any Benami property. Corresponding disclosure has been added in Schedule 3, so which means the company will have to make a disclosure. The details of the property, details of beneficiary, if property is in the books, then reference to item in the balance sheet. So if you just look at the CARO reporting requirement for this clause, it talks about if there is a proceeding, whether the company has disclosed. Now, if the company has given this disclosure, the auditor will have to report that yes, there is a proceeding and the company has appropriately disclosed in note so and so to the financial statements. So this is, how the intent of the announcement is, so that the chartered accountants and the auditors can take cognizance of the disclosures in the financial statements. And if I just cover two more on this slide to give you another set of changes in Schedule 3, and which has a difference in CARO 2020. So one of the clauses on the working capital requirement, and I'm sure many of you would have already gone through this clause's requirement of this clause multiple times. So this clause requires auditor to see whether during any point of time of the year the company has been sanctioned working capital limit. So if the company has been sanctioned working capital limit in excess of 5 crore rupees in aggregate from banks or financial institution on the basis of security of current asset, then whether the quarterly return or statement filed by the company with such banks or financial institution are in agreement with the books of account of the company. And if there is any discrepancy, the details are required to be given. Now, if you go to the, if you refer to the Schedule 3 amendment, they have made amendment to this clause. They said the company has to disclose not only the sanctioned working capital limit, the company has to give a disclosure for the borrowings, any borrowing. So in case of borrowings from banks or financial institution on the basis of security of current assets, disclose whether quarterly returns, statement of current asset filed with the banks or financial institution agree with the books of account. And if there is any discrepancy, the company will have to give the reconciliation and the reasons of material discrepancy. So CARO 2020 prescribes reporting related to sanctioned working capital limits in excess of 5 crore rupees in aggregate. However, disclosure requirement under Schedule 3 to the Companies Act are not limited to working capital, but cover all borrowings. Further, in Schedule 3, no monetary threshold has been prescribed, whereas in CARO 2020, there is a threshold of 5 crore rupees. Now, if I move to the next one, wherein the company, the requirement in clause 3.3f, it talks about whether the company has granted any loans or advances in the nature of loans, either repayable on demand or without specifying any terms of period of repayment or specific, and if so, then the aggregate amount and percentage thereof has to be disclosed. Whereas if you refer to the Schedule 3, it talks about disclosure to be provided in prescribed format where loans, advances in the nature of loans are granted to promoters, directors, KMP, and related parties. So CARO 2020 additionally requires percentage of loan granted. Further, in Schedule 3 to the Companies Act, loans and advances given to promoters, directors, KMP, and other related parties are considered. Whereas in CARO 2020, if loans and advances are given to other than related parties, these are also to be included. So reporting requirement in CARO 2020 are much wider as compared to Schedule 3 to the Companies Act. And this is on your undisclosed income. So I'll not cover in detail, but yeah, there is a corresponding disclosure in Schedule 3. And this is on willful defaulter. So you have a corresponding disclosure in Schedule 3. And on the term loans, on the utilization of the term loan, CARO talks about utilization of the term loans for the purpose for which the loans were obtained. Whereas in Schedule 3, it talks about borrowings. So borrowings from banks and financial institutions, whether used for the purpose for which it was obtained. So CARO 2020 prescribed reporting only on term loans, whereas disclosure under Schedule 3 are not limited to term loans, but also cover all borrowings. And the last point on the slide is on the ratio. So I just want to cover this here while we have a retail slide. So currently you have a standard called SA570 ongoing concern. So what the regulator said, and if you refer to CARO clause 319, it requires auditor to make a kind of a statement of financial solvency, you can say. It says that the auditor has to consider the financial ratios, aging and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying the financial statement, the auditor's knowledge of the board of directors and management plan, and then auditor will have to report whether he or she is of the opinion that no material uncertainty exists as on the date of the audit report, that company is capable of meeting its liability existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So which means the auditor will have to form an opinion basis the ratios, aging analysis, information obtained during the course of the audit management plan, and then give an opinion that there is no material uncertainty on the date of the auditor report, the date on which he or she is signing, that the company is capable of meeting its liability existing at the date of the balance sheet as and when they fall due. However, if you go to Schedule 3, it only requires disclosure of certain ratios, including current ratio, debt equity ratio, debt service coverage ratio. The formulas and the guidance is given in guidance note in Schedule 3. However, it also says that you need to ensure consistency in computation of the ratios, depending on the industry, depending on the sector, depending on the disclosure made to the investors. Also, the Schedule 3 requires companies to explain the items, which means how did you computed these ratios, and explain any change in the ratio by more than 25% as compared to the previous year. So CARO 2020 requires the auditor to comment on material uncertainty, which is over and above your going concern assessment, which you do in SA 570. However, there could be an interplay between the two. So, for example, if there is a going concern issue and you are including a material uncertainty related to going concern paragraph in the auditor's report, there could be a possibility that you will also report in this clause that the company may not be able to meet its liability within a period of 1 year from the balance sheet date. And this is on the CSR. So there are requirements in CARO to the auditor to report whether the amount remaining unspent has been transferred to a fund. Whereas in Schedule 3, you will see the detailed disclosures are required to be mentioned about the amount to be spent for the year, amount of expenditure incurred, shortfall, total of previous year's shortfall. Now, this is something very interesting because there was no such requirement till the previous year. So the company will have to see the previous year's shortfall, what does it comprises of, and the auditor will also have to make that assessment. This slide is just a summary of the interplay which I just explained, and I'll cover a few important clauses again, considering the time we have in CARO, and and I'll suggest you can keep on writing your questions in the chat box so that we can cover in the end. One of the very important clause and on which many questions are received from time to time is on the whistleblower complaint. Now, here the requirement of CARO is whether the auditor has considered whistleblower complaint, if any, received during the year by the company. The question comes, how do we interpret the word consider? So which means it's not just that the company has given you a list of whistleblower complaint and you're just going through. The expectation is, and what the guidance note also says, you will have to consider and also see what actions and steps have been taken by the company to resolve and to address such a whistleblower complaint. So auditor to evaluate whether whistleblower complaints are investigated and resolved by the company in an appropriate and timely manner. The auditor is also required to evaluate that the whistleblower mechanism is as per the applicable laws and regulations. The auditor is not required to consider whistleblower complaints pertaining to earlier years. This is very important. I also got an opportunity to work on the guidance note, and the questions were also raised whether the auditor is also required to consider the whistleblower complaint pertaining to earlier years while reporting under this clause. So the guidance note clarifies you do not have to consider the whistleblower complaints pertaining to earlier years while reporting under this clause. However, please do not forget that you have a responsibility of fraud risk assessment under SA 240. The auditor should also inquire from the management about investigation of all whistleblower complaint received and the findings, if any. The auditor shall review the minutes of the audit committee and the board meetings to identify the whistleblower complaints, if any. So this is just a scenario to explain that what could be the reporting implication. Now, if you have seen all the whistleblower complaint and those have been resolved during the year, your CARO report is absolutely fine, because you will state that the complaints were received and have been satisfactorily dealt with during the year. Scenario 2, the whistleblower complaint received during the year and satisfactorily dealt with before the audit report, again, no issue. Third is received during the year and is in the process of investigation, which means the management is taking steps. Then you will have to effectively report that the company is in the process of investigating the matter. Whatever the status is, you will have to make an assessment. And scenario 4 is whistleblower complaint received after the year end, but before the audit report date. So management and auditor to address the complaint and see what are the actions required and on this, and accordingly deal, not just in the CARO, the auditor will also have to make an assessment in the auditor's report, the main auditor's report, because it is very important to make such an assessment, whether it's the, what could be the outcome of the investigation and whether it is required to be reported as per SA 240. Another very important clause is fraud reporting. The fraud is much wider now. So earlier, it was only limited to officer or employees of the company, but now the auditor will have to report whether any fraud by the company or any fraud on the company has been. The auditor will have to report the amount involved. So auditor will have to make such an assessment again, and the auditor is concerned with fraudulent acts that causes a material misstatement in the financial statement. You will also have to keep in mind this clause when you will make an assessment under the clauses, the whistleblower clause, the undisclosed income clause. So if there is a whistleblower complaint, now it could be very much possible that if it's concluded there is a fraud on the company or by the company, so then in that case, you will have to evaluate the reporting implication under this clause. So we can skip this slide. Working capital limits, I think I explained this at the time of when I was explaining the interplay of Schedule 3 and CARO. So here, the auditor will have to make an assessment for the quarterly returns, while the reporting is at the end of the year. However, the fact that whether it is in accordance with the books of account has to be made for the quarterly returns. So the CARO guidance notice states that the disclosure is confined to the quarterly return statement, even if the monthly returns and statements are submitted by the company. Also, it is applicable only to the working capital sanction limit, which is in excess of 5 crores. So one of the issues is whether books of account on the basis of such a statement, quarterly returns have been submitted and prepared. So whether the auditor is required to audit such a statement, books of account, the answer is no. The auditor is not required to audit such quarterly returns or statement, but only required to compare the same with the books of account and report disagreement, if any. The auditor is also not required to audit the books of account on the basis of which such a statement, quarterly returns have been prepared and submitted to the bank's financial institution. The auditor, to ensure that management process for the disclosure is thorough and compare return statement with the books of account. The auditor will also have to assess that the disclosure is provided considering the sanctioned borrowings, even if the same is unutilized during the period as at the end of the reporting period. This clause is on the investment guarantee loans and advances. So if you go to clause 3.3, this is a very wider. So I'll just cover this clause in this slide only, because if we start discussing this clause, then you need at least another 30 minutes only for this clause. So this is 6 sub clauses. And the auditor's comment required all loans and advances in the nature of loans granted, guarantee or security provided to companies, firms, LLP, or any other parties as against those parties covered under Section 189 of the Act in the erstwhile clause. So earlier in CARO 2016, the auditor was only required to report on loan and advances granted to the parties covered under Section 189 of the Act, but now it covers all loans and advances, be it given to a company, to firm, LLP, or any other party, which means unrelated parties are also covered. The subclause A and D of this clause 3.3 are not applicable to companies who are in the principal business of giving loans, for example, the financial institutions and BFCs. It requires determination of gross amount, that is without adjusting any subsequent settlement of all loans, advances in the nature of loans, guarantees, security provided during the year to subsidiaries, joint venture, associate, and to any other parties. Subsidiaries, joint venture, and associates to be interpreted in accordance with the Companies Act 2013. So as I mentioned in one of the earlier slides, you will have to use the definition given in the Companies Act 2013. Whether advances in the nature of loans, not defined, but guidance given in the guidance note. So for example, if you have given an advance, which is akin to a trade advance, which you normally give to the suppliers for the defined time period, that could be advance in the nature of loan that is not covered in, advance in that could be other than advance in the nature of loan and therefore may not be covered under this clause. But advance in the nature of loans is covered, and the auditor will have to make that assessment. It also covers loans given in cash or in kind. The reporting is required. It also covers loans squared up during the year. So which means you have a nil outstanding balance. However, if there is a transaction during the year, if the company has made investment, provided guarantee, security, granted any loan or advance during the year, then it has to be disclosed and reported in this clause. Guarantee to cover only financial guarantees, and the auditor should continue to refer Section 179, 180, 185, 186, and 187 of the Companies Act while making such assessment. So I'll just skip these examples again in the interest of time, and I'll straight away come to another clause on auditor's resignation. I saw the first slide which Amit has presented in the session on the requirements. Again, the regulators are evaluating about the reasons of the resignation, why the auditor is resigning. The auditor should make a detailed, kind of a disclosure to the shareholder, and the shareholders are required to make such. Shareholder should be familiar of the reasons. So if you recollect, there is already an existing requirement of SEBI. So there is a SEBI circular which requires companies to file for the listed company if there is a resignation by the auditor. Also, the ICA has issued a detailed implementation guide on resignation withdrawal from the engagement to perform audit of financial statement. So there is already a SEBI circular and there is an ICA implementation guide, which the auditor should refer while reporting under this clause. So this clause requires auditor to see whether, first of all, there was a resignation of the statutory auditor during the year, and if so, whether the auditor has taken into consideration the issues, objection, or concerns raised by the outgoing auditor. So this will be applicable most likely in a scenario where incoming auditor is appointed during the year to fill a casual vacancy caused by the resignation of the auditor created in office of the previous auditor under Section 140. So if there is such a resignation and the incoming auditor, which means you are the incoming auditor, you will have to obtain a copy of the letter of resignation, look at ADT 3, look at the reason for the resignation, also refer to the last auditor review report and see whether there is any issue which should raise a red flag in your mind, which you believe that ideally you should have considered in your reporting, or you should not have accepted the audit. Probably that could be too late in the day, because probably that you would have done at the time of professional courtesy clearance, which means obtaining a no objection from the outgoing auditor. However, looking at the ADT 3 and the last issued auditor's review report, you will have to see whether there is any matter which requires your attention, which you believe should be included in the audit report you are going to issue for the entity. So this is on the material uncertainty. So I already covered this, so I'll not repeat. But yes, again, this is over and above SA 570. And the emphasis is on the company's ability to meet its liability. And this is different from your assessment of going concern. Another very important clause on internal audit, and maybe this could be the last clause before we can take up the question and answers. One of the requirements introduced in CARO is whether the company has an internal audit system commensurate with the size and nature of the business, and whether the reports of the internal auditors for the period under audit were considered by the statutory auditor. So while this is a requirement which was there earlier also and has been reinstated, but the fact that the reports have to be considered was not there in earlier CARO. So, and also it is very important to note that the requirement of maintaining an internal audit system is not applicable for all the companies. So Section 138 mandates it for the listed companies and prescribed class of companies, which means companies meeting specified thresholds. Now, what is the requirement here? The requirement is that wherever there's a requirement to maintain an internal audit system, the auditor should obtain all the internal audit reports before he or she signs off for the period of the audit, which means for your April 2021 to March 2022, you will have to report you will have to ask the management to share the internal audit reports for this period. And you will have to you will have to look at the findings, concerns raised by the internal auditor. You may have to have a discussion with the board of directors, with the management, with the audit committee. So that is something when I say that it has to be considered by the statutory auditor. However, the guidance note also says that if, for example, some of the internal audit reports are not available. So, for example, the companies may have a different timeline for the internal audits, or they are provided at a very short notice to you, which means you do not have time to go through it in detail. Then in that case, what the guidance note states, the statutory auditor should consider appropriate reporting in this clause, as well as consider its effect on the overall control environment with regard to reporting on internal financial control over financial reporting. So the guidance note states that you will have to consider the implication on your ICFR report. You will also state which reports you have not received, which means if I have not received reports for a quarter, let's say for an example, I'll have to state I have not received report for the period so-and-so from the internal auditor. The guidance note also provides an illustrative language, which all of you can refer whenever you have such a situation. So I'll skip these slides for the interest of time. The last one on the CFS. Many people ask this question, therefore I thought, at least this is also something which merits attention for a minute. CARO is not applicable to CFS except for this one clause, which is very important. So it requires that as a parent auditor, you will have to seek information from the component auditor. Now, what information you have to seek? You will have to go and you will have to include in your group instruction whether any of their CARO report has any qualification or adverse remark. And if yes, they need to report it back to you. They will have to report the clause number to you. And that clause number has to be included in your CFS report. So if you look at the reporting requirement, it says whether there have been qualification or adverse remark by the respective auditor in the company's auditor's report of the companies included in the CFS. So which means all the components which are companies, be it a subsidiary, JV, associate, wherever there is a qualification or adverse remark in the component auditor's report, you will have to indicate the details of the companies and the paragraph number of the CARO report containing the qualification or adverse remark. Now, in a situation where you are not the auditor, you will have to seek this information through group instructions, and you will have to include such reporting in your CARO 2020 report on CFS. It also says the guidance note that the qualification adverse remark given by the component auditor is presumed to be material to the component, which means I will not exercise any materiality judgment here. If the component auditor has reported any qualification or adverse remark, it will be included in the report on the CFS. Principal auditor is not required to re-evaluate the materiality, and the principal auditor will have to seek such a paragraph and the details from the component auditor. So the borrowings, I think we can skip, and I'll just straight away come to the key takeaway slide. CARO 2020 and the new reporting requirement, as I mentioned in the beginning, is far more judgmental, and it is no longer a compliance reporting. It is very much, it requires detailed additional efforts, and I'm sure all of you can appreciate that it requires definitely significant efforts from the management side as well as the auditor's perspective, because though we are not covering Schedule 3 currently in the session, but I'm sure many of you would have already seen Schedule 3 as you are gearing up for the your year-end reporting. So there is a significant effort by the companies as well as by the auditors. So there is important to identify all the challenges, seek information from the companies well in advance, and the additional disclosure should also be assessed by the company. So you should have a conversation with your clients wherever you have to identify the issues under at an earlier stage. And the last message is documentation is key. So as we say in audit, what is not documented is not done. So therefore, it is very important that we should maintain detailed working papers and files to support the work we have done. And with this, thank you. And I'll just pause here and see the questions we can take.
Yeah, thank you, Deepa. That was indeed a very interesting session on the CARO and Schedule 3 auditing aspects. A few questions. If any matter is not applicable to the company, whether the disclosure is required or not.
Okay. So I'll presume that this question is for CARO and for auditor's report. So if it is not applicable, then I'll have to state clause number so and so is not applicable. So I'm restricting my answer from the auditor's perspective and not stretching it to Schedule 3.
Right. Whether renewing inter-corporate deposit ICD agreement will be considered as overdue under the CARO reporting 3.3D. Okay.
So if I'm renewing that, okay, so maybe we are talking about a evergreening kind of a situation. So if it's being renewed closer to the date of repayment, so let's say, to take an example, the repayment date is let's say 31st March. So just within 7 days, the guidance note provides an example. Within 7 days, you renew it, then it will be considered as a evergreening and will require reporting in that clause.
Right.
Yeah.
The next question, I think answer is simple, but still for the benefit of members at large, I'll read it out. That provision for salary payable is made for March 22. Whether this amount is to be shown as a trade payable or it will form part of other current liability, other payable for the aging.
Yeah. So I think that is again a Schedule 3 question. Yeah. So you want to answer, sir, this question for the benefit
of others? So I believe trade payables, it would be classified as other payable, not trade payable, because in my view, trade payable is something for which we have received the goods or service,
right,
and which has been very clearly defined. Also, I think. So this would be other payable and then impact the aging.
Yeah.
Whether insider trading by KMP, key management personnel, detected and fined should be reported under frauds.
Okay, so we have separate regulations for insider trading. So therefore, it could be possible. So if there is insider trading, the management should conduct an investigation. We should look at the steps taken by the management and then see what is the possible implication. What are the steps taken by the management? Yes, it could have a reporting implication in your CARO clause on fraud. And as well as depending on the matter, you will also have to make an assessment under SA 240.
I agree. What would be the audit procedure to verify guarantees given by the company? Because typically it is out of books, off balance sheet, as we say. How the auditor should be cautious to ensure that it gets reported?
Okay, good question. But I think guarantees is something which are there since long, right? So probably we'll have to look at we'll have to ask the management to share, first of all, as a starting point of the list of guarantees, going through the agreements, looking at the board minutes meetings, and looking at the disclosures made by the company. So again, the as an auditor will have to get the information from the management, and then basis that we'll have to make a reporting here.
Correct. And if I may share, or if I may add, I think what needs to be reported are the financial guarantees, not the performance guarantees.
Exactly.
Because many times we've seen our clients having contracts with, against retention money sort of. So they don't want the money to be retained by their customers, so 10% or whatever against performances, and they give a guarantee, which is typically a performance guarantee. So in my view, this should not get reflected in the CARO reporting. They are the financial guarantees. Yeah, and the first point, if you ask me, and like rightly mentioned by Deepa also, are the board minutes. Because all the financial guarantees and securities and all have to be approved by the board as per the Companies Act. And therefore, the first thing would be the board minutes. And then, like she mentioned, the other documentation requirements. Last question, Deepa, that many times quarterly returns are submitted based on provisional books of account. How to report under this clause?
Yeah. So when we say provisional books of account, probably unaudited books of account, which may undergo a change. So the clause is very clear. It does not require an audit. So we will report basis the books of account approved or certified by the management or the board of directors, and basis that we will make that assessment. Because the clause does not impose quarterly audits for the companies in such cases.
Right. But just to add, Deepa, what you actually mentioned, but I believe that, especially in case of the small and medium enterprises, the normal practice is that inventory is entered right at the year end. As far as the debtors or the trade receivables are concerned, which are secured, current assets secured, those entries you would always find in the books of account, and you can, as an auditor, check on a quarter end basis whether they have been correctly reported in the returns to the banks or not. When it comes to inventories, I believe we'll have to educate our clients that now, as far as the inventory entries are concerned, or I would say the closing stock valuation, typically at the end of each quarter, they will have to enter in the system, their accounting system, package, software, whatever we might say, because ultimately as auditors, we have to report whether it matches with the books of account. Yeah. So for books of account, because those who are on SAP and all, it would not be much of a challenge for them. Sure. But those who are under some of the other packages like Tally and all, where at the year end, once the audits are to be done, they pass the closing inventory entry. In such cases, I think as auditors, we will also have to educate them that on a quarterly basis, this needs to be done.
Yeah, very important point, sir. Very well said. I totally agree with you. That has to be changed. If that has to be reported by the companies as well as by the auditor. Yeah. True.
Well, friends, I think we had a wonderful session today. A lot of questions, and I am happy that both the speakers, Amit Mitraji and Deepaji, were able to answer to our satisfaction. And at the end, I would just like to say that whether it comes to the auditor's report or whether it comes to CARO and Schedule 3, March 22 is going to be very, very crucial for us as professionals. And we need to gear ourselves up to meet the expectations of the stakeholder. On behalf of AASB, Deepaji, I thank you for sparing your valuable time and enlightening our participants on the auditing and the reporting requirements under CARO and Schedule 3. Thanks to all the participants who have joined this webinar. Thank you, and have a great evening. Thanks a lot.
Thank you so much.
Thank you so much.
Thank you, NMG and the whole tech team for their efforts.
Thank you, sir.
Yeah. Thanks to you. Thanks to all the participants. Thank you.